Hey guys, Gregory Joseph here. Welcome to Wall Street Weatherman. So, next week, the Federal Reserve is going to meet on Tuesday and Wednesday. Wednesday, they're going to announce that they are going to cut interest rates by a quarter point. And right now, there's over a 90% probability that they do that. So, that's fantastic, right? That's great. So, why am I nervous? I want to share some thoughts with you guys. The the cut itself is already priced in. It's baked in, as they say. The thing that matters more is what the Federal Reserve Chairman, Jerome Powell, says. His comments afterwards are what moves the markets. For example, after the last meeting in October, he made a statement, a simple sentence where he said that a cut in December is not guaranteed. Then he said, in fact, it's far from certain. The market grabbed on to those few words, far from certain. And in the following that, the next day and throughout the next week, the market fell a little over 5%. And as a matter of fact, it has not recovered to that prior high since then in the last about 5, 6 weeks. So what Powell says is huge. And so I want to focus on a few things. And that is that, look, I don't make predictions, okay? I want to make a caution statement. This is just how I'm feeling right now and how I'm setting up for next week. As we've talked about before, I don't like trading going into earnings reports. I don't like trading going into events such as this, but my positioning is what I can control. And so let me just talk a little bit about the dual mandate of the Fed. Very simply, they have a dual mandate. It is maximum employment and stable prices. Maximum employment, stable prices. Cutting through all of the reports and data that we've been getting, they are further away from their goal on inflation right now than they are on employment. Employment right now, the jobs data is a little bit mixed, but overall the job market is stalled. It's stalled. It is basically a low hire, low fire environment. So it's just kind of a little bit constipated, if I could say that. So, so then cutting to the inflation, that's the jobs, the employment picture. Inflation is, I want to talk about that for a second because so many people are focused on inflation and rightfully so because we had COVID, we had inflation spiked and but inflation is the rate of change of prices, okay? It does not talk about where prices are today. We all know, and some of us know better than others, that the prices today are high. Okay, so inflation is how fast are they going up? Are they going up at 2%? Are they going up at 3%? Okay, that's fine. That's important to think about, but where are they right now? All right, prices are high, and there are right now three consumers. There's a high-end consumer in the US market. Fine, fantastic. Equities have been doing well, investments have been doing well, fine. There's the middle tier, which has been struggling to stay afloat, and then there's the lower tier who has been getting slammed. They are watching bills go up. They are watching food go up. Their paychecks are not going as far as they used to, and it is a hard time for them. And just to um, I don't know, just a sort of side thought for me is thinking about the young people, the entry level job positions. There's a real slowdown in all of that hiring right now, which is so tough. I'm thinking about my son, for example. But so let's talk about this. So we talked about the fact that 25 basis point, which is a quarter of a point, a quarter of a percentage cut is already assumed for next week. If when Jay Powell, when the chairman gets up to speak, that is what moves the market. So if he indicates that the following meeting there is going to be a likelihood of a pause, and I'm not talking about just a pause and not a continuation of another cut, I think that the markets could really react to that. And here's why. The If that's the case, more recently, the Russell 2000, which comprises the smaller capitalization stocks, those are very sensitive to interest rates. Those smaller companies need to borrow a lot of money. So when interest rates get cut, their borrowing costs come down and it really affects them. So if the Federal Reserve indicates that there may be a pause at the next meeting, that Russell 2000 group is going to feel the effect and most likely sell off. Okay. Number two is what has been leading us in the last 2 months is healthcare, specifically biotech. Okay. Biotech is another part of business that is very reliant on borrowing money. So they're going to get affected as well. So we've got the Russell 2000, which represents what people have been talking about as far as the broadening trade, okay? Trades that are broadening out over the 11 stock sectors. But if that's the case, and we try to go running back to the AI trade, which we've done so many times this year, we try to go into broadening and then we go running, and that sort of collapses back a little bit, and the market goes running back to the AI trade, to the tech trade. That tech trade has been holding us up overall. We've been going back and back to it. My thought is, how many times can we continue to go back to that well, as they say? And would it work again, especially in light of the fact that the last couple of months, we've talked about the tech trade. We've talked about artificial intelligence and how the um, the doubts are coming into that trade as far as the over leveraged and the debt borrowing and the return on investment. Please see my previous videos. But I'm more and more with that in mind of the more recent weeks. I'm not quite sure we can just go running back to the AI trade and have that hold up the market. So the Fed says we're cutting, the Fed says, but we might have to pause next time. The markets go, what? Immediately they sell the Russell 2000. They take profits in biotechnology, and then do they go running back to the tech and AI trade? I'm not quite so sure. And then, a couple of other things that just we've been having a lot of good fortune throughout this year. Every dip in the market is getting bought, and it's getting bought quickly. Another thing is that can't continue. That can't continue, into perpetuity. Number two is the VIX indicator, the volatility index, which we've talked about previously, but it's so important because it paints a picture for how cautious, how fearful or not the overall market is as it prices out the options of the S&P 500 index for the next month, and how much those options cost directly translate into, are people fearful or are they more complacent? So generally speaking, a VIX rating, and on your app, on your Robinhood, Yahoo, on your stock market app, just type in the ticker VIX and you'll pull it up. Please have that on. This is such a good indicator for the market psychology in today, for today. So a VIX of about 15 is the market's feeling cool, calm. The VIX gets up to 20, they're a little bit nervous. 25, they're starting to feel it. And then if you get the VIX into 30 or above, that is some real nervousness, some real fear, and we can talk about it from there. But the VIX right now is floating around 16. So that to me tells me that the market is pretty calm and pretty confident. And not that I would say overconfident, but this is something that's in my mind because for the last 2 weeks, 3 weeks, all of the pundits that I see that come on to Bloomberg and CNBC onto the networks, they are really talking about a lot of the same stuff, and that is that they're citing history and they're saying, oh, throughout history, when this has happened in December and going into January and in the most optimistic way. There are all of these talks about history and the statistics of history, but I always look at history, which you know, and pay attention to it, but specifically with statistics, remembering my statistics courses in college and economics, that we've had some very atypical years that came from the pandemic and supply chains and stimulus money on and trade issues, everything. And so I get a little nervous when I hear so many people comparing today to history. So there's that. There's the VIX being very low, telling me that the market is, you know, quite comfortable. I'm wondering maybe a little too comfortable. And and then another one is just that there's so much speak about the rally into the end of the year, the Santa Claus rally. And again, when everyone is talking, like something is a given, that's when I start to wonder if, and usually throughout time, that is when there's a sudden unexpected change. So that's what I'm looking at. So right now, what I'm doing, and again, this is not a prediction, this is just me. I am choosing to be cautious. I'm choosing caution. Since April, since we had the tariff scare and the bottoming in the beginning of April of stocks of the S&P 500, since then, the S&P has run double the annual average. Okay, we have doubled what it should do in an entire year. We've done that in, you know, what, 3/4 of a year. So that to me is something I'm keeping an eye on. And so when it comes to my strategy and being cautious, I wanted to share a quote with you, that a story about Baron Nathan Rothschild, who came to England, um, and he came with about 20,000 pounds in his pocket. Uh, by the time, and he was a great investor, banker, and by the time he passed away, he was the richest man in the UK with millions of pounds. He said something when someone asked him what his secret is. He said, I never buy at the bottom and I always sell too soon. Okay. And we've talked about this in, I think it was How to Buy Stock Safely, but one of my previous videos. And this is something that I try to do. I try to avoid the bottom and the top, okay? Or if you're talking about a probability curve, I try to avoid those tails because the tail is where the risk increase is, quite high. So again, I never buy at the bottom and I always sell too soon. Down at the bottom, you've got fear. Up at the top, you've got greed. So that being the case, and knowing that we've had such a good run, we've had 3 years of a bull market, we've had an incredible comeback from this year since April, double what it normally is per annum. Lots of optimism. I get a little bit nervous when I only hear so much optimism. The VIX is complacent. So Again, I'm choosing to be cautious, feeling that are we getting somewhere near a point where things could pull back? And look, I'm not talking about a giant, collapse and of the market and nothing like that. I'm simply talking about right now what I'm doing with my trading position. I've got the investments that I have long term that I don't touch, and I've got the trading positions. As far as the trading positions, I have moved, taken profits, and moved quite overweight into cash. So I'm sitting on the sidelines, cash in hand with my options. Okay. And there's one other quote from this week from that I want to share with you. That's from an investor, a tech investor, Dan Niles. Dan is in California, and he's quite a very good tech investor. And what he said this week was that he is favoring. He was asked, so what's your trade right now? What's your position? He said, my trade is cash, and he laughed. And to me, that sort of gives me a double thought when it comes to the market. And if everything occurs as far as next week, which it might not, but if the Federal Reserve indicates a possible pause, is the market going to be able to run back and rely on tech like they have been for numerous times this year and even previous to that? Well, when one of the top tech investors, Dan Niles, says he's in cash right now, that is that adds to that thought. It's a little more, it puts a little more sand around uh, that thesis and that thought of mine. And so, um, look, again, just my trading position, I'm overweight cash, but I could be right. I could be wrong. The timing could be different. It could happen or not happen. My hope is that it doesn't happen. My hope is that I am able to avoid all of that. I'd rather avoid all that. I really would. And have my cash and have that be a buying opportunity for me. That said, I have reduced my risk because the first tenet, the first principle that we've talked about is what? Protect your money. Don't lose your money. And next week, I see a number of factors that are increasing the risk of a market event occurring. And I have to be cautious and protect my money before I can then go and put it to use and make more money. So I hope that's helpful. And this isn't a scare tactic. Again, this is just a caution statement. I want you to know, as a trader with the trading portion of my portfolio, what my mindset is right now. And I would love to be wrong, because if I'm wrong, I've still saved my money. I have a buying opportunity ahead of me, and that would be wonderful. So anyhow, that's it for today's show. As always, thank you for watching Wall Street Weatherman, and I'll see you again soon. Cheers.